Everybody, it's Jeff Quintin, and welcome back to the Quintin Group TV. Yes, I'm your host, Jeff Quintin. And today we're going to talk about what's happening in the mortgage industry, what's happening with mortgage rates, and how it's going to really affect you. Hey, welcome back. So today I have a special guest here. This is Kevin Braun from EMM Loans. EMM Loans is one of our preferred lenders that we work with here at the Shore. And Kevin and I are going to talk about and just have a quick dialogue about what's going on with regards to mortgage rates and how it's specifically going to affect second home borrowers and their second home market. So Kevin, welcome to our Zoom meeting here today. I appreciate you being on.
Thanks, Jeff. How you doing today?
Yeah, doing well, doing good. So let's jump right in. So Kevin, tell me, can you share with me and the audience here a little bit about, what actually is happening, and what do we expect regarding these loans and rates and so forth?
All right, a few things have happened. Rates, obviously the Fed has been increasing rates. So rates have been coming up. They've been, they went up about 0.5% over the last quarter. They're going to keep coming up a little bit. I think they're about to level off. Just to give you an example, say you were at 3%, now you're at 3.5. They should level off about 3.625, 3.75 around that point. So it's not a ridiculous amount. It's still lower than pre-COVID days. Before the market changed, before Fed was buying everything. What's happening is the federal government's just stopped. They're not buying as much securities. Rates are changing. The Fed's coming out raising prime to offset inflation, which is then pushing us into a market of a little bit higher interest rates, which is going to, cost everybody a little bit more to buy a house. So, if they wait, rates will go up. They should plateau at a certain point, but, now's definitely a time to make a move if you're going to. Values, I think, are going to hold in there for a little while longer, and we should be okay with that. They did come out with, as of April 1st, the federal government came out with restrictions on second homes as far as making overlays to increase the cost of getting a second home. They came out with a stance of they're more for a primary purchase. So what that's going to do is going to push it into the non-QM market, which is a little bit higher rates, a little bit different type of lending. But it's still available. It's still going to be there. You're talking about just paying a little bit more in interest rate, but you'll still be able to get those products. You may have to put a little more money down in the future, but for right now, it is still there. So it's, going into this time of year, it's a good time to get on it and buy or sell because you do have that market capture.
Okay, so all right, when we talk about money down, so a typical borrower, in the past, it was always one of those things where it was always 20% down, was always they get to that 80% loan to value, right? But then things freed up last couple of years where borrowers for second homes could get in at 10% down, right?
Yes.
Or 15% down. And so when we talk about down money and these new changes, how does that affect now as far as what's going to be required for someone buying a second home? Is it going to go back to 20% or is PMI coming into place? How does this all work?
It's going to go back to when you're talking about the traditional Fannie Freddie lending. They're basically pushing it to almost you need 30% down to make the rate make sense. They call them loan level pricing adjustments. So they put anywhere from 1.25% to 4% change in the interest rate. So it's an ad that they have for them securitizing that money. So that it makes it so you're going to have to put a good amount down to get into a Fannie Mae loan, and the rate's going to be higher. That's where there's going to be a void in the market. And there's always a bank, there's always somebody looking to lend money is going to step in. I think you're definitely going to be at that 20% down, 25% down. They'll eventually open up and there will be, when there's a need, somebody will fill it. It'll go back to that, but it'll just be at a higher rate. So it will cost you more to borrow that money on that second home.
So what I'm hearing you say is then ultimately anything less than 20% is going to be hard. There might be a market at some point, but it's going to really, the rate's going to go way up. And even at 20 or 25% down in a second home right now, the rate's still going to be jacked, right? Or even possibly 30%. They may require you to put that much down. So, if we're looking at the regular borrower, the normal, borrower that we work with, and today the average sales price has gone way up. So let's just use the number of 600,000 as a sales price, which is still a big number, right?
Yep.
So typically before a borrower putting 20% down, $120,000 down, they're going to finance 480. Today, that borrower might, instead of having to put 120,000 down, they might have to put 180,000 down just to get to the same rate that they were at before. That's what you're trying to say?
Yeah,
so they might have to come up with that much more money down, which is a significant amount, right?
Yeah, it's a big amount. It's pushing, they're saying basically they don't want the paper for the person with the second home. It's a riskier to them. It's a risk. It's not what they're saying. It's not what they were designed for. They were designed for primary housing. They did get into the second housing investment, and they're pulling back on it. So they're making it a second home is going to be looked at as an investment property by the Fannie Mae, Freddie Mac of the world. They do have jumbo still hasn't been changed because that is not on that. It's not considered a conforming or a qualifying mortgage. So that has still stayed the same, but that will trend up a little bit as time goes.
So, okay, so let's talk about jumbo then. So that everyone understands what jumbo means. Jumbo is a higher loan amount, right? And what does that start at? The jumbo?
I believe it's 620s. It is where it starts at. Anything above that, so you would have to be above that amount. However, with jumbo, you're required to put. We do have a 10% down jumbo product, but it's a higher rate. You're paying to put that to be able to put 10% down. Most jumbos want 25% for a second home. So that you're still losing that, that being able to put 10 to 20% down. They're going to require most people buying a second home. It's going to be to get a good rate and to get a good program. You're going to be required to put anywhere from 20 to 30% down.
Okay. Except for if you're a jumbo, meaning if it's say a loan amount of 620,000 or greater loan amount, which means even if somebody's putting 25% down, add that onto the 620. Now we're up to, an $850,000 roughly, purchase price. So what we're saying is anything, if you're buying a home at 800,000 or say 850,000, whatever that number is, or above, putting 25% down, the rate really won't be as affected. If you're a borrower buying something that where your loan amount's 620 or less, that's where the rates are going to be affected. Is that what you're saying?
They're definitely affected. Yes, the amount to put down. Now, all rates have gone up. All rates have been affected by the market, and the Fed's coming out in March, and they're going to make an announcement if they're going to raise it a quarter or a half. Some people say they're going to raise it three times this year. Some people are saying 5 or 6 times. I've heard as far as 7 times. I don't know that they're going to raise it that much. I don't have, I'm not that into the market, but they're definitely raising it, and it's definitely going up. I would think it's going to be each quarter they're going to raise it about a quarter. So prime's going up. Everything that's a HELOC, everything that is an adjustable, your payments are going to go up. So banks are being charged more to borrow that money, so they're passing it along.
So in the bread and butter market, so I guess I'm hearing you say is then it's likely that what we looked at last year for, some of the rates were 2 3/4, right, or 2 1/2. There's crazy under 3. Today we're at 3 3/4, 3.35, whatever that number is. So what I'm hearing you say, if this continues, we're going to see over 4% for sure. Most likely we're going to be over 4.
Yeah, it would be, which is a normal rate. That's still
yeah. It's still low. I'm just saying from where it was, but yet the difference maybe is rate may be a point more this coming year, and yet the amount down may be as much as 10% or greater or more at the same time. So before, if you had $100,000 to put down, right now it may require you to put $150,000 down, right, roughly, and the rate's going to be that much more. So the old rule of thumb that we always said is that if there's a 1% rate increase, then it gives you a 10% buying power. So before, if you're looking to buy a house for $600,000 at the one rate, and today you buy it for $600,000 at the new rate, higher rate, well, that same payment would actually, you're only going to get a $540,000 house, right? So you get 10% less buying power. And so in our market, it makes a difference, right? It makes a difference between a 3-bedroom to a 4-bedroom. It makes a difference between 1 block to the beach versus 2 or 3 blocks back of that 10% value, right? So I can see that it's important that if you're looking to buy, get in now, take advantage of this. It's way more affordable, and the amount required down is much less, right? And so I see that. So question though, let's talk about real quick, credit score. Does this affect credit score in any way? Because it seemed like anybody was getting a loan again in the last few years, and you had different programs. So how does that affect now too?
Yeah, the credit scores are still the same. The higher your score, the better rate you get. It's not really affecting your down payment. It affects your rate and how much your mortgage insurance is if you do get into that, or are fortunate, you get into that now. It's when you do have that mortgage insurance, it's going to be a little less with a better rate, but it's not going to change how much you can put down. With the jumbo, they want higher credit scores. You're not going down into the 600s or below 600. You're going to have to be in that 680, 720 market in order to get a loan. So it does limit you with that. So they're they're basically saying I would say now's the time if you're looking to buy and you want to take less money of your assets. Now's the time to make the move. I know the values are up. Don't see them going down. This was a different market than before where people were putting more money down. They're higher qualified buyers. So they're going to hold on to those houses. The houses are going to stay there. It was just a shift. COVID made a full shift it wasn't, it was different people buying. It was people buying because they wanted to have a second home. They wanted to live a different life. They, got hit with the reality of being locked down, and now they want to live a little different. So, and I think that's going to continue. I think everybody thinks that things a little bit different than 2 years ago. And if you're thinking about getting into the shore properties and you're looking at buying a second home or buying an investment, now's the time to do it.
Yeah. Yeah. So I guess a few things in the next 12, 24 months. One is rates are going to definitely go up. Amount of money down is going to increase. Property values are still going to keep going up. So, we see that with inventory being less, the demand being so high. So again, going back, if you're a buyer looking to get in, especially like when I say bread and butter, and it's crazy to say bread and butter today, $600,000-700,000 as a sales price, right? But the reality is, if you're going to have a loan amount of 620 or less, okay, then that's who's going to be affected most. And so you need to get in now where the rates are lower, more affordable before things really kick in as far as down money is required, more of that. And then I guess if you're a seller, hey, if you're selling a bread and butter type of property, 850,000, let's say, or whatever it is, or less in value, your pool of buyers is going to shrink, right? Because,
Absolutely.
Pool of buyers, maybe that buyer had only had 20% down to work with. They only had 100 grand. They only had, 120,000, but now it requires them to be 150,000 or 180,000. It's that extra 10%, right? And so, how long does it take someone to continue to save that amount of money, right? It takes sometimes that buyer a longer amount of time. So that pool is going to shrink. So one is, I think the pool of buyers are going to shrink, which therefore is going to make it a little harder. Maybe some adjustment there. I don't know, in that lower end, who knows? And again, that's something that the seller needs to look at and say, okay, hey, if I'm thinking about selling, why not sell when the affordability is at its highest with rate and about money down? I think this spring selling season is going to be the best we've seen, in a long ever, really. Now what's going to happen next year? I don't know. You don't know. But one thing we kind of know is rates are going to be much higher. We already talked about that. We know that's going to happen.
They're going to go up.
So borrowers, I think they're on the fence. If you've been waiting, even though, hey, prices are high, I'm going to wait till they come down. Well, the challenge is that prices are high. We get that. Values are continuing to rise, but rates will. So your buying power goes down. So today, if you're looking at a home, buying one for 600,000, today, your rate's affordable. 6 months from now, that same house is going to be a buying power of 540 or even less. You're going to go one block, again, now closer, or one back further from the beach. You're going to get one less bedroom, right? Or whatever. Instead of getting a second floor, you're going to a first floor. So I don't know. It seems like this is the opportune time, right? So,
absolutely, I agree.
Kevin, how does someone reach you? What's the best way if they're looking to refinance? One, because refinancing with rates, right? Refinance, purchase, get pre-qualified, learn a little bit more about this. How do they reach you? What's the best way?
Email kbraun@emmloans.com or my phone number, 856-366-0944.
Awesome. Well, again, thank you so much for being with us today. Give us this insight. Again, anybody out there looking to buy, sell, invest, thinking about getting your home in the market, you want to know what we can get for it in this market. By the way, you're going to be very surprised. Reach out to us direct. You can reach out to me, 609-398-5333, or simply email me, jeff@thequintingroup.com. Appreciate it. Thanks for watching.